And welcome back. Now, the third annual South African Investment Conference to attract business to the country started yesterday in Sandton, north of Johannesburg. And in his weekly letter on Monday, President Cyril Ramaphosa said that he is confident that this conference will be successful and attract investment. It will focus on subjects like the energy plan, small business growth and infrastructure investments. However, Dr. Nthabiseng Moleko, who is a development economist from the University of Stellenbosch Business School, says that many of the promises and pledges that are usually made at these conferences never materialize. And she joins us now to discuss this further. Dr. Moleko, thanks for your time. Welcome to Morning Live.
Thank you, and good morning to all your listeners. Thanks for having me.
So you say, Dr. Moleko, that many of the pledges made at these conferences actually don't materialize. So what actually happens then? And how do we know that this actually doesn't materialize?
I think the first thing is that we need to look at the national investment rate and target. So what was targeted initially from the South African economic cluster is that we want to see 25% of our GDP coming from national investment, or rather the FDI contribution being 25%. I think I'll put it better in that way. But the current approximate value is under 20% at around between 18, 17, and it trails from the last 10 years between 17, highest point being 20.4. So what we have seen now with the investment summit since 2018, you would have wanted to see the target was 1.2 trillion, equivalent to $100 million, right? The first year, 2018, the estimated pledges were 290 billion, just under 300 billion of an estimated 31 projects. Last year, it was reported that of those 31, 8 projects were completed or realized, right? 8 out of the 31, 17 in construction. So out of the 31, you've lost 6, which are not being reported. The second is this year. Of the 17 that were still in progress, it's not clear, and maybe it will be announced today, how many of those have been reported. The second thing, and the reason why I say that, is that the investment summit is almost relating policy fatigue, in the sense that a lot of promises, pledges are made that ordinarily may still have been in the annual plan, strategic plan of many companies. Why do I say this? When you look at the gross fixed capital formation percentage and proportion, and you compare it year on year, South Africa is still sitting at a very low level of 17.9%. And that talks to the reinvestment of your private sector investment and public sector investment into the real economy. And you're seeing year on year, it hasn't ticked up post 2018. 2019, and particularly this year with the COVID recession, you may see it backtracking because of disinvestment globally and the shock effects. So I'd say that we need to have a clear investment tracker that tracks reinvestment, that tracks the realization of the projects that haven't been realized, and that also tracks and monitors both public investment, which is on a downward trajectory, and fixed private sector investment, so that you can measure the real impact. Are we anywhere near the $100 million? In the 5-year trajectory? So you must remember the target was 2018 to 2022, we would invest or see an investment of $100 million US dollars, equivalent to this 1.2 trillion. We have not even seen, I don't think, half of that coming into the real economy. And the last I want to add is cash reserves, or what is called cash hoarding, reported by CCRED, and also independent analysis by the World Bank, show that we've actually seen in the outer years real disinvestment and 1.4 trillion hoarding of cash reserves in the economy. So these JSE-listed firms have dropped investment between 2001 and 2016 by 10.5%. And CCRED levels this up to 1.4 trillion. And this is very significant disinvestment by the private sector. I don't think we're seeing the real money in productive capacity and in real investment into the economy. I don't see it in the numbers.
And against the backdrop that you have just sketched, why then should foreign investors see South Africa as an attractive investment destination?
All right, so what drives up investment promotion? One, infrastructure. So the president and his team are really on the right path to say that infrastructure is a critical enabler. I think that what is important is that you cannot really have an infrastructure-led growth, right? This is South Africa's choice, is to have an infrastructure-led growth path. What you need to have is an industrialized growth path. But The other aspect is that you need to have a predictable regulatory framework, i.e. certainty on land reform, certainty on, for instance, if you look at subsectors, the things like the mining charter, ICT regulatory framework, and a lot of these things that the private sector and investors would see as what they call bottlenecks. So we are competing with other emerging markets. We are competing with Brazil, China, India, and other emerging markets globally for the very same investors. So those who are seen as more business friendly and have an enabling environment would attract these capital inflows. It doesn't help that we have had downgrades and we are seen in terms of adversely, in terms of risk premium because of the cost of, because of the effect of the downgrades and the sovereign rating downgrades that we have had from these rating agencies. So what I would say is critical for South Africa, therefore, is to boost its own investment drive, use its own domestic surpluses and reinvest those in your productive capabilities. Most countries that have grown, Sakina, are countries that have looked at how they can use their own capital to reinvest into manufacturing as a proportion of exports and doubling their manufacturing value add. Why? We have three critical problems in our economy: unemployment, how are we going to deal with that? Inequality, and the issue of the low growth trap that is driving poverty linked both to unemployment and inequality. So we need to have manufacturing as a subsector that we zoom into, and we have a manufacturing or industrialized growth path, that industrial incentives are used and focused on those, that we use our financial markets to boost investment into that subsector and make sure that new black economic entrants, SMMEs, are supported into those. We talk a lot about localization, but the reality is that SMMEs, because of the type of global value chains, because of the retail value chains, and because of the oligopoly type market that we have, where you have a few companies controlling the large majority of most of our subsectors, it's very difficult for small, medium enterprises to actually enter. So we need to change these also for our local firms and not just look at, foreign firms. Let's look at local investment and try and enable economic activity across the board. I would say those are key things in terms of driving up investment promotion.
Dr. Moleko, this is the third annual investment conference in South Africa. In your view, looking at the past two conferences, would you say, that they've been successful? Have they actually achieved the sort of objectives that they set out to? Are these investment conferences actually worth our time and energy and the efforts and resources as well?
If we could put the same amount of emphasis on drafting an economic strategy that is not only an economic recovery plan that targets 3% growth, we can spend and have the same stakeholders, have Treasury, have the National Economic Cluster, have the presidency and his advisors look at how can we grow the South African economy by 6%. This is the minimum requirement to deal with the unemployment crises that is on our hands, with more than 10 million South Africans unemployed. We need to have less than 15% targeted unemployment. We should use all of our instruments, all of our thinkers, all of our business investment into coordinating an economic strategy that not only is viable, but will break the structural path and the investment pathways that we've historically had. Have we had a successful, I'd say, historical economic overview? No. If you look at the success indicators, right, from an economic perspective, don't only focus on debt to GDP, which is fiscal sustainability. Focus on growth. South Africa has a lackluster growth. South Africa has had downward private and public sector reinvestment, right? And if you are implementing austerity in a time of an economic shock like COVID, when the rest of the world has shown that you have to stimulate your economy because your trade and export numbers are down, your FDI is down, your consumption or household aggregate demand is contracting because there's wage drops, people have lost jobs in the quarter, and we are seeing that there's no real economic stimulus coming elsewhere. What we should be focusing, instead of focusing on announcements, pledges, summits, conferences, events, workshops, we have to get together, build a decisive economic strategy, break the boundaries that we have not been able to get out of. And I think we really need to change also, Sakina, the theoretical underpinnings that drive South Africa's economic cluster. We are stuck in a neoliberal economic framework. We are refusing to accept the Keynesian economic stimulus, which talks to the issue of the role of the state. We've got to look at how do we fix the capacity of the state. Market failure exists in the private sector. Private sector is profit-driven. We have to use our state-owned enterprises in a more efficient way, have cost models that are sustainable, but also reinvent how we use our SOEs to deal with the triple problem of unemployment, poverty, and inequality. We cannot do away with SOEs because they help us in reducing the cost of inputs that business or private sector will not do because they're not designed to deal with those issues. So I think we are focusing on the wrong things. I think if we can just rewire ourselves, we need to reboot our economy. And I think there's a lot of ideas around what we can do. And I am very hopeful that as a country, we can come out of this quagmire we're in of a low growth trap and a poverty trap. But we have to do things differently. We have to plan differently with our state institutions. We have to have targets that are monitored, and we have to have impact that is measured by the investment and the other drives that we have. But we cannot target for ourselves in the out years 3% growth, 1.5% growth, as we have seen with the National Minister of Finance's new medium-term budget policy statement, and 1.7% growth, which only will absorb 1 million people into the economy. We have to do better. When 10.8 million South Africans are out of work, out of the economy, not economically active, and we're only targeting a growth of 3% and 1.5 and 1.7, which will only absorb 1 million people in 10 years, yet we have an outstanding 10.8 million that we have to talk to. And remember, year on year, you're adding to the youth, to the labor market, an additional almost 1 million people that you are still going to have to deal with in the exclusionary labor market. So there's a real issue of the structural reforms needed, and these should not be micro reforms. I think we have to look at what are the fundamental macroeconomic reforms? How do we use our trade policy, monetary policy, fiscal policy conducively, jointly, in a coordinated fashion so that we can see different outcomes? And I'm making a call to say it can be done. We just need to think and put on our caps a different type of mindset.
So how do we then get those who formulate policy, those who are in charge of the country's purse strings, to see this issue the way that you do, Dr. Moleko?
One, they must read. I wrote a report called New Wine into New Ironskins, an alternative economic strategy for the reconstruction of South Africa. I think what for me was key there is that I saw, having done a lot of the analysis on the economic indices over the last 50 years in South Africa, there's about 18 indices that I investigate from a subsector level, looking at the issues of the different policy frameworks that we've implemented. That's just one indice of the 18. There's a multiplicity. You look at market cap, you look at debt to GDP, you look at fiscal sustainability, public investment. But what you must look at in all of our economic plans are the outcomes. Let's be honest about the outcomes of all the strategies we have employed. Have they led to gains? What have been the employment impact? How have they changed the labor market construct? Have they been able to do what we call matching of skills demanded and skills supplied in the market? The outcome, what has the outcome been on inequality? All of these point to failed outcomes because the economic impact of all the interventions, it doesn't matter which one you look at, over the last 50 years, it hasn't absorbed the majority of South Africans, but also it hasn't been able to change the economic trajectory beyond the growth path track that we are in. That's number one. So we first must accept and agree that we have not been able, with the historical methods, mechanisms, and tools, sufficiently dealt with the historical inequalities, the inefficiencies of the economic injustices of the past. Therefore, as a result of that, we therefore need to employ different tactics. If the economic model is based on a successful model, which hasn't worked, and we think that we can rebolster within that framework what isn't working, I think for me that primarily is the problem, one. And I think two, the way in which the economic cluster works and coordinates itself, I would say we need to review that. The president in the economic recovery plan talks about building state capacity, talks also about eradicating corruption. I think the issue there is in what way are we going to rebuild state capacity? What are the key planning changes? How is the government going to plan its economic cluster differently? How is it going to use the SOEs and the instruments at its disposal to employ and to have different outcomes? That doesn't come out very clearly. So what we should be doing is to say, from these SOEs, if we employ and use the 800 billion public procurement purse to rebolster subsectors of the economy, focus on, let's say, pharmaceuticals as a case in point, and we use our fiscus and the hospital budgets to localize preferential procurement, must be used in alignment to that. Therefore, how do we change the laws? The laws must enable us to do that and not hinder us to do that. And I'm not saying we must steal from the public purse. I'm talking about using public investment to drive a localization drive and industrialization, which is critical. Most countries have what they call infant industry protection. South Africa joined the WTO, jumped a lot of barriers in the sense that jumped trade tariff or GATT tariffs by more than what was necessary, allowing foreign competition, just decimating complete industry subsectors and not looking at the real effect on some of your industries and how you need to also bolster your own industries to remain competitive. I'm not saying industries must be not competitive, but to make sure that you are sustaining local business that is competitive, that can compete on par with those that are going to come in. So I think we haven't done that sufficiently, and I think we need to do a lot more of that. I'm of the view also that we need to reform our value chains. So these value chains, if you look at supermarkets as an example, they are controlled by 5 companies, control 96% of our supermarkets and our value chain. They also control the supply chain, i.e. SMMEs and how they enter in. Let's focus on that. How are SMMEs entering in? Are those environment and the conditions conducive to growing our SMMEs? Who are these companies that control 96%? Are we happy that 3 companies in supermarkets control 82% of the supermarket value chain? And that's most of your household goods. And so you're having a situation where cartels or oligopolies, rather, are controlling the majority of your economy. And this is to the detriment of its own growth goals. And I think we haven't focused enough on some of these structural constraints that actually hinder the growth of the South African economy.
Dr. Moleko, so much that I'd still love to, get your views on, but unfortunately we're out of time. Just literally in 10 seconds, 1.2 trillion rand over the next 5 years is what we're hoping to get from these investments. Do you think that's possible? Just very briefly, we are out of time.
What is possible is South Africa using domestic surpluses, pension funds, capital markets, disciplining capital, money we have. Let us change the Regulation 28 where we need to. We can use our own investment and then it will crowd in private sector investment. Let's also use our fiscal measures and fiscal policy to also crowd in investment. That will also bolster crowding in of the private sector. If we don't stimulate our own economic activity, it is unlikely that we are going to have foreign direct investment coming in, as has been the case historically. It's not just now, and especially with the economic shock of COVID. So let's use our domestic surpluses and our resources. That then crowds in all the other type of investors as you boost economic activity, particularly in industry and manufacturing and your primary sectors, so that you can then bolster growth, drive up employment, and make sure that your SMMEs in the main in South Africa participate locally in this bolstered growth drive.
Well, thank you so much for your time this morning, Dr. Nthabiseng Moleko, development economist from the University of Stellenbosch Business School, talking to us about the 3rd annual investment conference that is currently underway in Johannesburg. With that, time for the latest news.